Okay, good morning, everybody. It's Gary Fuller here. And it's November 24th of 2025. I had some questions about regarding when to take a spring and when not to take a spring. And that is really a criteria that wyckoff students need to perfect. Many say, well, so I'll just take the spring, but they'll take a spring for weakness. That's not something wyckoff obviously advocates. It's not something that you should do on a consistent basis. So so what's really critically important is to understand when to take springs and when not to take springs. And our level of knowledge of springs to buy them is to buy them when you have a prevailing uptrend and also the background being bullish. That's the ideal spring that you want to take. But there are other springs that are a little more, um, let's say, aggressive, but they should be taken regardless of being aggressive or not aggressive because the risk reward is so good. But the one thing for sure that you need to establish with springs is that you have some underlying background of bullishness of buying. To buy a spring because the market's necessarily oversold at the reverse trend line is an aggressive move. I do it, but also you have to be able to run from danger when you're wrong. So on a website like this, I don't advocate that, but there are certain ways the risk reward at that level is really, really good. And I've showed that to you guys in the past. So my idea is to just really to show you what the basic and intermediate levels of when to buy a spring, when not to buy a spring, and it will serve you well. Just one example that I'll show you today. This happens to be a 15-minute E-mini S&P. I think it's over the past, I think it was maybe last month. I don't know what it was. It was earlier. That was, let's see, what is this? It's the 20, it was Friday. Okay, Friday's the action. So let me just go over that to you and I'll show you the establishment of when to buy a spring, when not to buy a spring, or in ranges and or not ranges. So here you see on the left-hand side of the market, okay, I'm going to label this so we don't get Trump translation. So you see a market in a defined downtrend. And we're looking for stopping action. And stopping action is that, or some type of volume that occurs. Okay? Some type of volume that occurs. Okay? So what do I see? I see a high volume bar. Now this is usually the end of the day, but let's just take the volume bar as it is. Then we have a bar that we have a bar that's a very critical bar. The bar tries to go down from weakness, goes up and gets sold right here. This is a potential aggressive change of behavior bar. I really don't want to be focusing that bar, but to bar like me, who's been doing it for 45 years, it's an important bar because it's the first time that you see that type of bar. When you see that type of bar, okay, a bar that just stands out like a sore thumb, when you see that type of bar, okay, it's an important bar to mark. May not trademark it. So I draw that line across from here. And I want to show you lines across from there. These kind of mid-range calls, and that should form some type of trade range. If it comes into play later on down the road, that's awesome. If it doesn't, we can still use it as a guide initially. Okay? Fine. So what happens? I'll try to use it properly. You have some type of behavior. This is overnight that tries to go down, up, middle range. So that's the first time that we see a stand being taken by the bulls of stopping action to the downside. When you see this type of action, immediately draw your reverse trend line. In this case, it really wasn't oversold, but many times you'll catch a particular move in that regard. So that does not come into play. These lines sometimes get drawn afterwards, and it takes a level of understanding them to be the point to where you don't make it fit, but you try different styles of reverse trend line. As long as about 45-degree angles, they generally work quite well. So since this bar was a wide bar, There's a high volume bar. We want to mark this high volume bar as well. And we come across. Boom. Okay. Now, as the market has gone through some type of potential stopping change of character or change of behavior bar, that's going to form the left-hand side of the trading range where your level of knowledge is the weakest. The left-hand side of the trading range is where volatility occurs and where the market starts to begin to build cause. Most people will buy or sell say prematurely, and this way they'll get caught on the market retesting. Don't do that. I said don't do it, you'll end up doing it because it's just part of trading. Try to do as less as possible. Okay? The least mistakes we make, the better. All right. So we have this here. We have oversold market doesn't hold there. That's fine. This is a sausage making, I like to call it. The sideways trade range. Since this was a markdown bar, that gets marked as well. So we have these lines drawn in advance so we can tell a story versus scrambling when they occur. So we have nothing discrete about these bars. They're all small range, and nothing happens. Go back down, we know some type of retest. Here's the right-hand side of the market, gets the retest. As the market tries to go back higher, we don't even really buying bar to get long on. Even though this bar is a good bar, it's not absorbing anything yet. It's just the middle of the range. We do not want to take that bar. That is not a bar that says action bar to say jump on board. It's a regular buying bar after some bad news happens, some good news. We have to wait for the establishment of the market to prove the bullishness. Why? Because the market has background of weakness. Right? The market has background of weakness. So if I don't get some type of strength, here, then I do not want to buy that. This is not strength. It's short cover, it's not strength. It needs to be larger volume and larger range. So I will not take that trade. So I'm looking for changes of character to the market. Market's back down. Now we got a full retest of a spring boom. This is a very good reaction bar. We like that action bar, right? Now in the middle of the night, you're not getting much volume. What about price action? We like that type of bar. We like that type of bar. Okay, why? Because it tells us a change of character. Okay, changing that close of character of the markets. So this is a change of behavior bar that occurs because it's the widest bar that occurs in the whole sequence, and it happens on the right-hand side of the trading range. It's the left-hand side, no ending action, no ending action. It's because the right-hand side, we start to get some type of level, forget the volume. Sometimes we get this sticks like a sore thumb. So we have one bar up, and we go up a little bit higher, stop probably mid-range, then we get the break. The break is what we want to see. Well, this is that reverse absorption, but it's a retest. Since this was a buying bar, we draw the line across. I would look to try to buy a spring of that bar because I'm buying in the background. It's aggressive, but my risk reward of buying that spring and the stop right here is very good for risk reward. So, as far as that goes, the market now is at a level in which we have the change of character, but look what happens here. 1, 2, 3, 4, 5. 1, 2, 3, 4, 5. To trade back to 1, 2, 3 bars up. So we have 3 bars. This is very important. We have 3 bars up. It's kind of what David Weiss did with his wave structure. Okay. We now have 5 bars down. Kind of sounds like Elliott, right? That's what he got it from Wyckoff. 5 bars down to the market. the break is less sharp than the rally. Rally is sharper, 3 bars are sharper than 5 bars. That's the first time that's happened. It happened on the right-hand side with cause being built. Now I can expect my sign of strength or my demand bar. I should, from this level here, on a retest of a buying bar, I should get my strength, a retest of a buying bar. Do I get that strength? You bet you know what you do. Right there. So a slow retest after, so it's all sequence. Buying, stopping action, a slow volume retest in demand. Okay? Now I'm looking to buy a spring. Okay? Or next happens. We get activity. There's nothing to buy here, nothing to buy here, and we get a spring. Would I buy this spring? The answer is I would buy this spring. I would buy that spring. Good volume, mid-range close, I would buy that spring. No, I don't know if that spring's going to retest. I don't know if that's a terminal spring that's going to go straight up, or a retest that's going to come back down. Well, lo and behold, I got a volume like this. The volume dries up. That's okay. We're lower. Market dries up as long as the upside is more bullish when it rallies. Then we get this bar as a spring. That's a buying bar retest. We go supply in the market, and we get our strength, and off we go. So we're not buying this over here, right? Spring here because sauce making, but we're going to buy the right-hand side after we see some buying. Is there a chance you could buy before the buying? Yes. But for our discussion afterwards, it's important. Okay? Now, would you buy a little spring maybe in here? It's not perfect. Depends on the day. If you're aggressive, you're making money, go ahead. And the wyckoff student, no. It's our level, don't do it. Because most students that are learning cannot extradite themselves from getting out and they tie up an opportunity for next time. So we get the initial change of behavior, their retest with little cause, okay? But we need that strength. This is not good enough. Change of behavior is not that strength. We get strength. We get that strength. Now we're going to see if there's no supply on the downside. Volume increases, but does not take out this low. Bullish sign, right? So to the buying bar there, have a spring. Could buy that spring, right? Because it's a high volume. This is a wyckoff's favorite spring, a high volume spring, shorter range. This one is a spring on this bar. Either one of these bars are strong bars that should be bought. It's on the right hand side with cause and market that way. Middle of the range. If you buy a spring on the middle of the range, you just got to sit through the trial and tribulations of the volatility of the sauce making that may occur in the trading range. If you're buying it on the right hand side, you're not waiting that long because the market's about to make a move. But you want to get in before that move, like on that spring or springboard. So the level of knowledge in the middle can be right, but a lot can happen before it gets to the right-hand side. Okay? So to travel from the left-hand side, right-hand side, it's very, very difficult. Okay? So you want to buy, as we buy, trade behavior buy, the spring buy, market, this one here. In worst case scenario, we have a beautiful SOT that occurs right here. It doesn't get better than that, right? Only because we have larger volume. Downside, same volume. Well, this is bag holding. So sell it down, it's bag holding. And go ahead. So you want to wait for the shorter thrust bar? Go ahead. You want to wait for this bar here? Go ahead. I would buy this bar here. You notice by doing it right, you never were at a loss for except for, hours later at a loss. So not that difficult, but in the middle of the range, you can do it. You just have to sit through it. You have to sit through the trade. Are you patient enough? Most people aren't. You got the way to get out of the trade range is by cluster closes, right? Absorption, reverse absorption. Not necessarily cluster close, but the close higher end. Okay. So they kind of absorb there to give you that absorption process. If you don't see the absorption process right inside, the odds are the market's not going to mark up. It'll continue to be in the trading range as far as that goes. That's the difference. Thank you for listening, and I hope you see you down the road, folks.